I'm Matt Bishop with NAREIT here in New York City at the Waldorf Astoria Hotel for REITWeek 2016, NAREIT's Investor Forum. Joining me today is Greg Steele, Managing Director with Capital One Securities. Greg, thanks so much for joining us.
Thanks very much for having me.
So let's start by talking about capital market activity. Has the level of activity this year surprised you at all?
Not really. You have to think about the broader factors, not just the real estate specific factors, but the broader factors of what are going on in the capital markets. So from a fundamentals point of view, we've continued to enjoy very strong fundamentals, stable cap rates, demand well exceeding supply, strong rental and NOI growth. But if you look at what's been going on in the broader capital markets, if you think about the first 6 weeks of 2016, we saw a steady drumbeat of bad economic news. We had, concern over energy prices. We had concerns over China. We had weak economic data here at home. And so we saw a very sharp sell-off in equities, and the RMZ traded down about 10.5% between Jan 1 and February 11th. The S&P also, traded down below 1850. REITs were trading about 10% below NAV, and only a small number of deals got done during that period. Between mid-February and mid-May, we saw about a 21% rally in the RMZ. S&P rallied above 2100, and the REITs traded back to pretty much at NAV. And the volatility, of course, dropped quite considerably. And so we saw a very nice rally in equity deal activity, and a lot of deals were upside during that period as well. So, and similarly on the bond side, we saw a similar impact because that kind of volatility also has a dampening effect on issuance activity there. And if you look at January and February, there was a very small amount of deal activity done. March, the door started opening, and we've seen quite a nice pickup in a rally. We're probably about even where we were last year in the bond market. But many first-time issuers, though, have still stayed back. I think they're waiting for the second half of the year to see if conditions in the markets are calmer. So, not surprising given the backdrop of what's been going on in the equity and bond markets. Now,
shifting to the IPO market, it hasn't been a lot of activity that we've seen there. What are your expectations for the second half of the year?
This has been a very tough year for IPOs. We've only seen one transaction, MGM Growth, in April, which was a nice one. It raised $1.2 billion. In 2015, we saw 5 that raised about $1.2 billion. In 2014, we saw 6, and they raised about $4 billion, and Paramount was a big part of that. So there's always an ebb and flow in REIT IPO activity, but I also think that institutional investors are setting a higher and higher bar for IPOs, and for the quality of IPOs, and for the size of IPOs. REITs are very scale-driven, so you think about how difficult it is for a new REIT to compete with some existing public REITs and what kind of size and scale they need. So I think size does matter. In addition, there's obviously a very strong bid from the private equity sector, and a lot of management teams might find the private equity bid to first of all, give them a better valuation, and simply be easier than becoming a publicly traded REIT. Congress has also recently tightened the rules on REIT spinoffs, so that's going to probably prevent any of those from coming about. So, I think there is room, however, so that's some of the negative factors, but I think there are certainly there's a good possibility we'll see some REITs come public later on this year. We're certainly in dialogue with several management teams that are looking to enter the public markets. It's still a very attractive option for some. I think management teams that have a solid track record, attractive assets that are properly valued going into the transaction. And of course, if we experience a little bit more calmness in the markets over the balance of this year, then I think that we will see a modest pickup in IPO activity over the balance of this year.
And lastly, switching to M&A, are there any sectors or any segments where you see more potential for activity?
Well, there's been a lot of talk this year about NAV discounts in the REIT space. REITs traded down below net asset value in the earlier part of this year. A lot of that is really been, has really traded away, and we've seen REITs come back to NAV. But we also know that there still remains a very strong bid from the private equity firms to acquire public REITs at, below NAV, and there's certainly certain names and certain sectors that continue to trade below NAV. We saw a couple of large transactions in the fourth quarter of last year, obviously Blackstone taking Biomed and Strategic Hotels private, for example. These big players have a record amount of dry powder available to them, and they continue to look for large scale platforms. That's what they need to do, is they need to acquire in size. And I think there is still potential for more of that take-private activity to occur. You know, the CMBS market has also been a bit of a challenge this year, and that's a key ingredient. So if we see a healthier CMBS market over the balance of this year, I think that could also help M&A activity. So I think there is still room for public to private M&A to play out further, especially for, you know, certain individual REIT names and sectors that are trading below NAV. So, you know, I do think there will continue to be that trend, that public to private PE-driven trend over the balance of the year.
Greg, thank you so much for joining us.
Thanks very much for having me.
For more from REITweek 2016, be sure to visit REIT.com.